Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel. Thank you for tuning in for another one of these informal videos. We're in week 4 of the lockdown here where we are. Go ahead and let me know where you're at and how many weeks you've been locked down. But we're trying to make sense of this whole stock market mess and maybe find some stocks to buy. Excited about today's video because those of you in the nation know one of my favorite sources for stock market news and data is this FactSet Earnings Insight release. Now this is a bi-weekly newsletter put out totally free that's pretty much a survey of all the analyst information there on Wall Street. And with that first quarter earnings just being reported and the stock market intensely watching that second quarter guidance from companies, this is probably going to be your best source for information. So we'll look at some of those highlights from the most recent release, but I want to use most of the video for something revealed in that research. The 10 stocks with the highest and lowest expected returns according to the Wall Street analysts there. So FactSet compared all the median price targets for every stock in the S&P 500. Okay, so that's the 500 largest companies in the United States, domiciled in the U.S. The expected one-year price target for each stock by those Wall Street analysts compared to the current price for each stock. Now I'm going to leave a clickable index in the video description below if you want to check that out. Jump to that, those best and worst stock picks, but stick around because this is really going to be a great resource for investors. Like I said, I've used this FactSet Earnings Insight release almost weekly, all the way back to my analyst days. It's a great resource for kind of figuring out where the market is and which stock sectors. And now I don't want to steal my own thunder here, but these are going to be some amazing returns if these stock picks work out. Okay, these top 5 stocks to buy are all trading at less than half their target prices. So that's better than 100% return. Conversely, we'll also look at those stocks that analysts are expecting to actually drop from their current prices. So 5 stocks with losses of between 8.5% to as high as 16%. Stocks you definitely want to avoid over this coming year. And we're going to get to all that, but I want to give just one more shout out to everyone in the Bowtie Nation. If you're not part of that community yet, just tap that little red subscribe button. It's free and you'll never miss an episode. So I'll be using the April 9th release, which is the most current as I'm researching this, but you can always find the most current release of this FactSet Earnings Insight by going to Google and search for FactSet Earnings Insight. It's usually the top result, but just look at the date published and then you'll see a little PDF symbol there by the title. Now the report always starts with this key metrics bullet points, but the entire report isn't that long, so I just scroll through and kind of look at some of these individual sections. Next, they always have a topic of the week as well, and this week they highlighted that median stock market target from analysts. So we see that analysts on Wall Street expect the S&P 500 to turn to about 3,200 over the next 12 months, which is about actually 18% higher than the current price right now. Now, what's really great about FactSet, though, is they break everything down by sector. So the 11 sectors of the economy, and it's all put in easy to understand graphs. So at the sector level, analysts are expecting communication services to be 23% higher over the next year. Now remember, that sector was created about a year ago from the telecom and online services space, so it includes a lot of these different industries, but all that should do relatively well even in this shelter-in-place environment. And so as we talk about these stock sectors, if you want an idea of what stocks are in each of those sectors, you can go to the SPDR ETFs page. That's SPDR for SPDR ETFs. So for this one, we'll look at the Communication Services Select Sector SPDR. That's ticker XLC. And you go to their holdings information. Now they'll usually show you the top 10 stocks in this fund and how much each stock makes up that fund, but you can always download the entire list. And here you see the sector includes stocks like Facebook, Alphabet, which is the parent company of Google and YouTube, T-Mobile, Electronic Arts, Verizon, Disney. Now analysts expect stocks of financial companies to also do well. So here we're looking at the Financial Select Sector SPDR ETF, that's ticker XLF. And we see all these very large banks, so payment processors, insurance companies. Here we have stocks like Berkshire Hathaway, Bank of America, and American Express. Now, I love the communication services sector because a lot of these are actually going to get a bump from everyone staying at home and online. Banks and financials, not so much. I'm not so sure of. Granted, typically when you have that wave of stimulus money and the Fed stimulus programs, that's going to benefit these large financial companies because they're going to be the first ones to make those loans and to see all that wave of money come through the financial system. The problem is rates are so low and that yield curve is so flat, it's going to be very difficult for money lending banks to make money. Now, in fact, the banks had to fight to get one of those federal government programs to increase the rate on those emergency small business loans, the payment protection program, to just 1% to cover those servicing costs. Okay, at first, lenders were only going to be able to make like a 0.5% on those loans. And they just couldn't service them at that rate. So they had to fight with the government to get that bumped up a little bit to 1% just to cover some of those costs. So going to be very hard to make money, especially in those lending banks, the ones that derive most of their income from interest rates and from lending for like mortgages and stuff. So if you're looking at these financial stocks to buy, I'd focus on more capital market banks and then the payment processors. So you got banks like Goldman Sachs and JP Morgan rather than banks like Wells Fargo, which is much more of a mortgage lender and a personal lender bank. Or you've also got exchanges like the CME Group, which runs the Chicago Mercantile. On the other side of this graph, analysts expect only about an 11% upside in stocks of consumer staples companies and a 14% upside on energy. Now, the consumer staples forecast is probably a function of the fact that these stocks, the stocks in these sectors, haven't fallen as much as the rest of the market. So maybe they don't have as far to rebound either. In fact, here I want to share another resource with you, and everyone here in the nation has seen this one. But if you go to the Select Sector Spiders website, click on Tools, and then the Sector Tracker, you can see how each of these stock sectors has performed over the different periods. So a day, a week, a month, year to date, and even longer periods, a year and 5 years. So if we look at year to date, we can see the stocks in the consumer staples sector has only fallen about 7.7%, which is about half the loss of that overall stock market drop. Now, other relative winners here are, of course, healthcare stocks, which at that 6.9% loss so far this year, and stocks of utility companies, which are down less than 6%. So you definitely have that idea of those safety stocks and companies with stable sales even in a recession. Those consumer staples, healthcare, and the utilities companies. Energy is kind of an interesting bet here, though, because that sector is down over 43% so far this year, just getting smashed by those lower oil prices and the drop in demand. But analysts see this rising by just 14% over the next year. And actually, this is where I disagree with the analysts and say this might be your best bet as a contrarian investor, so kind of betting against the grain there. We've just got the historic output cut from OPEC and Russia, so it looks like they don't want a price war after all. And while this hasn't really totally saved the price of oil, because we're looking at a huge drop in demand, it should still support some of that energy market and some of those stocks in that energy sector. And a lot of these stocks are just down so much. Now, there is a lot more to that Earnings Insight report, so check that out. Google search for FactSet Earnings Insight. But I do want to get to those 5 best and worst stocks to buy because this is a really interesting list. I do have to add that disclaimer here, though. Understand that these are just the difference in analyst price targets versus the current price. So first, analysts can be wrong, and they often are. These are people that spend 50 and 60 hours a week digging through those financial statements, though, and following stocks, but they can still be wildly off. So you do need to do your own research before jumping into any of these stocks. Second, though, and you'll notice that a lot of the best stocks on this list are just the ones that have been hit hardest. So the theme seems to be with analysts right now that they're expecting from a year from now, all this coronavirus and everything is mostly going to be fixed, mostly going to fix itself, and those stocks that fell the most are going to be the ones with the most to rebound. So that's one theory, but it depends on the idea that this is going to be a short recession and that these companies survive. So if you didn't see our video about a week ago, I talked about how to measure financial survivability by looking at a company's balance sheet. Okay, again, during normal market times, economic growth, you want to look at that income statement to see sales growth, earnings growth, really how fast a company is growing. But in these times of recession, you have to pay attention to that balance sheet. It's going to show you how much cash the company has on its balance sheet, how much cash it has stored away, its debt, its long-term debt that it has to pay. You combine that with interest payments from the income statement as well as debt maturities from the annual report to give you a sense of that financial survivability. And that's probably the most important thing you need to look at during this times of recession, this economic uncertainty. So I'm going to leave a link to that video in the description below. Make sure you check that out because this is the most important idea in investing right now. Making sure that a company has that cash and the financial flexibility to survive through all this so it can eventually rebound. Now we're going to start with those worst 5 stocks to buy according to analyst estimates. And here actually you can see the top 10, but I'm only going to talk through the top 5. You see the median target stock price in the second column, and then the most recent price for the stock and the difference. And again, most of these, with the exception of that Occidental Petroleum or ticker OXY, haven't done too badly. So maybe analysts think there just isn't a lot of upside left in these stocks. So I want to show you a chart of the worst 5 stocks here. So this is Clorox, ticker CLX in green, with a 21% return year to date, followed by a Market Access Holding, that's ticker MKTX, and a gain of 6%. Now we have Illinois Toolworks, ticker ITW, and McCormick, ticker MKC, are both here, but with about the same return as the S&P 500 year to date. Now among these, I would actually be more bullish on Clorox and McCormick as safety plays. While we might have already seen the low of the bear market, I think the recession and unemployment is going to be around for longer than really most analysts are predicting. So even if you don't get those huge returns from these safety sectors like utilities and consumer staples, they're still going to provide that protection and the dividends while you wait. Now we see the top 10 stocks to buy according to those analyst estimates, and I think this is where the real danger could be. I fully appreciate that the hardest hit stocks have the furthest to rebound, but I'm not sure if I'm ready to jump into these travel and tourism stocks just yet. Now, if you do want to take that risk, I think you can put maybe a portion of your money, maybe 50% of your cash into these high-risk stocks and then hold the rest back for that just-in-case scenario. This is where studying that balance sheet and making sure that those companies can survive is really going to save your ass, though. And a chart of these really backs up that idea of rebound stocks. So we see that 13% loss on the stock market year to date, and then all down here, these top 5 stocks. You've got Norwegian Cruise Lines, ticker NCLH, and Carnival, ticker CCL, down at the bottom with a 75% and an 80% loss. DXC Technology, ticker DXC, and MGM Resorts are right around that 58% loss. And then AIG Group, that's American International Group, is there with that 48% stock price decline. Now, of these, I think DXC and AIG are the most interesting because they're not in that travel and tourism industry. DXC Technology provides software and solutions for business use, but even better, that cloud and platform services in mobility and Internet of Things. So really well positioned in one of the leading trends in the market. Now, American International Group, or ticker AIG, is still largely an insurance company, but also has that full suite of financial services, including credit and investing. It's also got a lot of debt on the balance sheet, though, but pretty normal for a financial company, and there's no real existential risk here, right? There's no, meltdown risk for this finance company. Now, the shares pay a 4.8% dividend and plenty of cash flow, so I think this is probably the least risky of these top 5 or 10 best stocks on the list. Now, I do want to point out 2 of these other stocks in this top 10 by analyst forecast, Kimco Realty and Simon Property Group. These are both real estate investment trusts that own retail property and mostly shopping mall space. We've gotten a lot of questions about these retail properties and these mortgage REITs on the Facebook group, so I wanted to address this because while the stock prices of both of these have come down 50% year to date and analysts are forecasting those triple-digit returns, I'm not a fan of the retail space REITs yet, or even the mortgage REITs for that matter. Those department stores and the shopping malls were already in that slow death spiral before all of this, and that was with record consumer spending. Now more people are realizing how easy it is to shop online. So even when we do get back to some kind of business as usual, and that could still be months away, even then, that trend to weakness in the malls is just going to accelerate. Click on the video to the right for 5 more stocks I'm buying for triple-digit returns. 5 stocks with an average analyst price target of 80% or higher from the current price. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.